Have you ever felt that feeling when, right after a long-awaited purchase, the price of an item suddenly plummets? Imagine buying a new smartphone, only to have its price drop by $200 the next day. Now apply that feeling to your entire investment portfolio. Let's say you bought Bitcoin for $104,000 in November 2024. You truly believed in the asset, conducted thorough research, and watched as major institutional players finally entered the market. BlackRock launched its ETF, and MicroStrategy bought up billions of coins. However, now you're watching the price fluctuate between $85,000 and $98,000. A logical question arises in your mind. The one that plagues everyone: if all-time highs have been renewed, ETFs are working, and institutional acceptance is a reality, then why hasn't the price reached $150,000 or $200,000 yet? What exactly is eluding you? Many investors who have invested between $18,000 and $95,000 in recent months believe in the technology and scarcity theory, but they can't understand why the price movement is so out of sync with institutional adoption. There are mechanisms by which modern financial structures can legally suppress asset prices. These aren't secret conspiracies, but rather specific financial constructs that have previously been used to destroy billion-dollar corporations. These structures are completely legal and have historical precedents dating back more than a century. The same scenario that led to the collapse of hundreds of companies in the early 2000s and allowed empires to control entire nations through debt is now potentially unfolding against the world's largest Bitcoin holders. Every owner of the world's first cryptocurrency needs to understand this. Let's start with a story that at first seems unrelated, but will ultimately clarify everything. In 1982, Mexico took what seemed like a sensible step at the time. The government borrowed billions of dollars from international banks to develop infrastructure and fuel economic growth. The problem was that this debt was denominated in US dollars, not Mexican pesos. Mexico doesn't control the US dollar, can't print it, and can only obtain it through exports or new loans. When the US Federal Reserve sharply raised interest rates in 1982 to combat inflation, Mexico's debt payments soared. The dollar strengthened, the peso weakened, and the country found itself in a bind, owing $80 billion with no way to repay. Then the International Monetary Fund intervened with the so-called bailout package. In reality, this meant structural adjustments. Mexico was obligated to privatize state-owned companies, cut social spending, and open its markets to foreign investors. Essentially, the country was forced to sell off its assets to pay off its banks. Similar scenarios later repeated themselves in Argentina, Brazil, Indonesia, and dozens of other countries. This is a classic example of a debt spiral. Its destructive power lies in psychology. When you owe money in a currency you don't control, you risk losing sovereignty and control over your assets. This same mechanism applies not only to countries but also to corporations. Currently, there is a company holding over $60 billion in Bitcoin whose structure makes it vulnerable to this trap. Let's consider a simpler example. Imagine you own a house worth $500,000. You take out a $100,000 line of credit with a variable interest rate against it. While rates are low, you pay, say, $400 a month, which is quite manageable. But when rates rise, the payment increases to $900, $1,000, or even $1,200, even with a flat income. If you can't keep up with your payments, you have three options: sell your home, refinance the debt under more difficult terms, or default, after which the bank will repossess your property. When you're afraid of default, you start making desperate decisions, and the bank simply waits, knowing you're trapped. This is financial pressure without committing a crime. Now let's scale this situation. Instead of a house, there's $60 billion in Bitcoin. Instead of a line of credit, there's $16 billion in convertible bonds and preferred stock. And instead of an ordinary homeowner, there's MicroStrategy, a publicly traded company whose market capitalization directly impacts its ability to hold onto its assets. Understanding what's happening with this organization helps us understand the reasons for the artificial suppression of Bitcoin's price. Formally, MicroStrategy is a software company, but in reality, it has become a disguised Bitcoin leveraged fund. The company raises funds in three ways: by selling common stock, issuing convertible bonds, and placing preferred stock. This money is used to purchase cryptocurrency. They currently hold approximately 450,000 bitcoins. At current prices, this amount is worth approximately $45 billion, with the purchase costs being approximately $27 billion. An unrealized gain of $18 billion sounds impressive, but there's a catch. Bonds and preferred shares impose strict obligations. Bonds require interest payments, while preferred shares require dividends, which, unlike common stock, are mandatory. Failure to pay them means default. MicroStrategy requires approximately $700 million annually just to service its debt and pay dividends. That's nearly $2 million every day. The company's core business generates only about $100 million in free cash flow, which is clearly insufficient. A cash reserve of $1.2 billion has been established to cover liabilities. At the current rate of spending, these funds will last approximately 20 months, or less than 2 years. This is where the danger of a debt spiral lies. The company's shares are currently trading at a premium to net asset value. If you subtract the debt from the value of all the bitcoins on the balance sheet, the result is, say, $30 billion, but the market values the company at $50 billion. This $20 billion premium exists because investors believe the asset will continue to grow and continue buying. As long as the premium exists, the company can sell shares, raise cash, and buy even more bitcoins. This creates a flywheel. Buying the asset pushes the price up, which drives up the share price and allows it to raise more capital. The problem arises if the shares begin trading at a discount. If the market decides the company isn't worth more than its net assets, MicroStrategy won't be able to issue new shares, as that would be tantamount to selling Bitcoin at a loss. Then the only barrier to having to sell cryptocurrency to pay off debt would be the 20-month reserve. If forced selling of Bitcoin begins, its price will decline, causing the company's shares to fall further and forcing it to sell even more assets. This is a classic death spiral. Why would large institutions or banks push a company into such a situation? Imagine a major investment bank whose clients, pension or sovereign wealth funds, want to invest in Bitcoin but can't do so directly due to volatility, regulations, or custody issues. What if they could buy the asset at a huge discount? Instead of the market price of $95,000, they could get it for $70,000 or $75,000. If MicroStrategy finds itself in a critical situation, it will not sell assets on the open market, but will resort to block trades. Banks will buy billions of dollars worth of Bitcoin at a discount of 10, 15, or 20%, then resell them to their clients at a premium or keep them for themselves. To implement such a plan, the company would need to be under stress, its shares trading below their net asset value, and its cash reserves depleted. This pressure can be created through short positions in shares. While there is no direct evidence of a coordinated conspiracy, history is replete with similar examples. In the early 2000s, there was a scheme for financing private equity investments in public equity, specifically deals with unlimited convertible bonds. Hedge funds lent money to companies in exchange for shares. With the lower the share price, the more securities the lender received. This created a direct incentive to drive down the stock price through short positions and negative rumors. An investigation by the Securities and Exchange Commission found that the shares of companies involved in such deals fell by an average of 34% per year, with almost half of them ultimately going public. MicroStrategy has a different debt structure, but the psychological dynamics are similar. If market participants believe the company will eventually be forced to sell, they will short and wait. In February 2025, the company's market capitalization dropped to a level where it was valued $10 billion less than the value of its bitcoins. You could buy shares and essentially get bitcoins at an 18% discount. The market was pricing in the risk of a debt spiral, given the $16 billion in debt. During this period, there was a colossal amount of short selling. Prominent investors like Jim Chanos openly declared their bets against the company, and JP Morgan analysts issued reports declaring its overvaluation and the risk of being delisted from major indices, which would have triggered even more selling. This isn't necessarily illegal manipulation, but it creates powerful pressure on a structurally vulnerable organization. Modern financial warfare often relies on exploiting existing incentives. If a company executive sees their shares being decimated by short sellers, they have few options: Continue buying in hopes of a reversal, issue new shares, diluting the owner's stake, or pay off debt by selling Bitcoin, which is the last thing they want to avoid. The pressure isn't aimed at destroying Bitcoin technology, but at forcing large holders to sell their assets at a discount. What should an ordinary investor do in this situation? First, it's important to understand that MicroStrategy isn't Bitcoin itself. It's a separate corporation with its own risks. The company's problems don't mean the decentralized asset is flawed. Second, pressure from institutions confirms their interest in Bitcoin. They want to own it, but they're looking to buy it cheaper. The worst thing a long-term investor can do is panic during moments of artificially created tension. Institutions want you to sell them your coins for $85,000 so they can sell them to their clients for $150,000 in 2 years. Third, keep an eye on the time frame. The aforementioned 20-month reserve creates a certain countdown. The closer the deadline, the higher the volatility will be. However, if the Bitcoin price recovers sooner or the company is able to refinance its debt on better terms, the death spiral theory will fall apart. Let's consider an example. You bought 0.1 Bitcoin for $10,000 when the price was $100,000. Now the price has fallen to $92,000, and your loss is $800. If you give in to fear and sell the asset when it falls further to $78,000, your loss will increase to $2,200. But if you understand the rules of the game and buy the asset at the bottom, increasing your total position to 0.2 Bitcoin, then when the price subsequently rises to $140,000, your capital will increase significantly. Psychology is key. Winners are not those who possess all the information, but those who can control their emotions. When the price falls, professional investors don't ask about the size of the loss, but about the reasons behind it. If the underlying asset hasn't changed, but the price is suppressed by financial engineering, they buy more. This is precisely how wealth is redistributed from retail to institutional investors, not through fraud, but through massive psychological pressure. Bitcoin, due to its volatility, is the perfect tool for such maneuvers. This has happened before in the gold market. In the 1990s, central banks sold off their reserves en masse. The Bank of England sold half of the country's reserves at an average price of $275 per ounce. This event went down in history as Brown's bottom. Officially, gold was dismissed as a relic of the past, generating no income. However, over the next 20 years, the price rose to $1,900 per ounce, and the British Treasury lost billions in potential profits. Some believe this was a coordinated action that allowed private banks to buy gold at a low price. Institutional selling creates pressure, the price falls, smart money accumulates the asset, and then prices recover. Given the current Bitcoin situation, the following steps should be taken. Don't sell the asset amid short-term fluctuations if the long-term fundamentals remain unchanged. Carefully study MicroStrategy's quarterly reports. Data on cash reserves, debt obligations, and cryptocurrency balances are real signals, unlike market speculation. Diversify your investments, not concentrating everything in one asset. And most importantly, improve your financial literacy. Understanding the mechanics of debt spirals and convertible bonds provides a huge advantage. Financial engineering is a tool that can both create wealth and extract it from uninformed market participants. Many, seeing their portfolio decline, conclude that they made the wrong asset choice, when in fact, they were simply outplayed by those with a better understanding of the rules. Investing is not about making perfect predictions, but about risk management and patience. The fact that large institutions are expending so much effort on creating complex schemes to buy Bitcoin at lower prices only confirms its long-term value. Complex short-selling strategies aren't built against worthless assets, they're simply ignored. If you believe that a scarce, decentralized digital asset will retain its value in a world where governments print trillions of dollars, then price manipulation shouldn't change your strategy. On the contrary, it opens up new opportunities. If you believe Bitcoin is a bubble, then you shouldn't own it at all, as volatility and pressure will continue. These are the rules of the game, and the only way to win is to understand them better than those trying to take your money. Continue to analyze how markets work, as a good education is the best defense against any financial manipulation. Clearly understand what you own and why, and then you'll be able to recognize any attempts to force someone else's game on you.